Right now, as you watch this video, the United States national debt is climbing at a rate of $83,000 per second. By the time this sentence ends, America will owe another $250,000. The total has reached $38.86 trillion, a number so massive that every person in America, including newborns, now carries a debt burden of $113,638. This is not slowing down, it is accelerating. How did the wealthiest nation in human history accumulate nearly $40 trillion in debt? More importantly, what does this mean for ordinary Americans trying to buy homes, save for retirement, or simply afford groceries? And perhaps most critically, is there any path forward that does not end in economic crisis? These are not theoretical questions. The decisions being made today in Washington will determine whether your savings hold value, whether your children inherit opportunity or obligation, and whether America maintains its position as the engine of global prosperity. To understand where we are, we must understand what national debt actually represents. When the federal government spends more than it collects in taxes, it borrows money by selling treasury bonds to investors around the world. These bonds are promises to repay with interest. The national debt is the total of all outstanding bonds that have not yet been repaid. For decades, this system worked because America was seen as the safest investment on earth. Lenders believed the United States would always honor its debts. The numbers tell a stark story. According to data from the Joint Economic Committee, the debt increased by $2.64 trillion in just the past year. That translates to $7.23 billion added every single day, $301 million every hour, $5 million every minute. To put this in household terms, the debt burden per American household now stands at $288,283. The debt cycle operates through a mechanism that seems simple, but carries profound consequences. Congress authorizes spending through the federal budget. When tax revenues fall short of these spending commitments, the Treasury Department issues bonds. Investors, including foreign governments, pension funds, and individual savers, purchase these bonds. The government receives immediate cash to fund operations. In return, it promises to pay back the principal plus interest over time. This system depends on one critical factor: confidence. As long as investors believe America will repay, they continue lending. The interest rate they demand reflects their assessment of risk. Data shows the average interest rate on marketable debt has risen to 3.355%, up from 1.512% just 5 years ago. This seemingly small increase has enormous implications. Higher rates mean higher interest payments, which means more borrowing to pay existing debt, which means higher future interest costs. Economists describe this as a debt spiral. Three major forces are converging to accelerate debt growth at a pace that alarms economists across the political spectrum. First, entitlement programs are expanding faster than revenue. Social Security, Medicare, and Medicaid were designed when life expectancy was lower, and the ratio of workers to retirees was higher. As the population ages, more Americans draw benefits while fewer workers contribute payroll taxes. Some experts believe these programs will require fundamental restructuring to remain solvent. Others argue that modest tax adjustments could preserve them. What is not in dispute is that current trajectories are unsustainable. Second, interest payments are consuming an ever larger share of the budget. The Congressional Budget Office projects that net interest will account for 13.85% of all federal outlays in fiscal year 2026. Within 2 years, that figure is expected to reach 14.52%. This means nearly 15 cents of every dollar the government spends will go solely to servicing debt, not building infrastructure, funding research, or providing services. That money is simply lost to interest payments. Third, political incentives discourage fiscal discipline. Raising taxes is unpopular. Cutting spending is unpopular. Borrowing allows politicians to fund programs and tax cuts simultaneously, deferring the cost to future administrations. Both major parties have contributed to this dynamic over decades. Analysts argue that this represents a fundamental failure of democratic accountability. The benefits of spending are immediate and visible. The costs of debt are distant and abstract until suddenly they are not. The consequences of this debt are not theoretical. They are already reshaping American life in tangible ways. But for homebuyers, rising interest rates driven partly by government borrowing make mortgages more expensive. When the government competes with private borrowers for available capital, it pushes up the cost of all loans. A family seeking to buy a home faces higher monthly payments, making home ownership less affordable. Research indicates that sustained high debt levels correlate with lower long-term economic growth, which translates to fewer job opportunities and slower wage increases. For retirees and savers, the picture is equally concerning. As debt grows, investors may demand higher returns to compensate for increased risk. This could lead to inflation, which erodes the purchasing power of fixed incomes and savings accounts. Alternatively, if confidence in American debt falters, all bond markets could experience volatility that destabilizes retirement portfolios heavily invested in government securities. For businesses, uncertainty about future tax and spending policies makes long-term planning difficult. Will corporate taxes rise to address the deficit? Will government contracts shrink? Will inflation force the Federal Reserve to raise interest rates sharply? These questions hang over boardroom decisions about hiring, expansion, and investment. Some experts believe that persistent debt uncertainty is already suppressing business confidence and economic dynamism. The United States does not exist in economic isolation. The dollar serves as the world's reserve currency, meaning international trade and finance depend on confidence in American stability. Foreign governments and institutions hold trillions in U.S. Treasury bonds. China, Japan, and European nations are among the largest creditors. If these investors lose confidence, they might reduce their holdings, driving up interest rates and forcing the U.S. to offer higher returns to attract buyers. This would accelerate the debt spiral. Data suggests that some nations are already diversifying away from dollar-denominated assets, though the trend remains gradual. The privilege of issuing the world's reserve currency has allowed America to borrow at lower rates than would otherwise be possible. That privilege is not guaranteed forever. Economists debate what would happen if confidence collapsed. Some believe the dollar's entrenchment is so deep that alternatives remain decades away. Others warn that tipping points can arrive suddenly. It's triggered by geopolitical shifts or fiscal crises. What is clear is that America's ability to borrow cheaply depends on global perceptions of stability, and those perceptions are shaped by fiscal policy choices. The path forward divides economists and policymakers into camps with sharply different visions. One perspective emphasizes growth. Advocates argue that if the economy grows faster than the debt, the burden becomes manageable. Investments in education, infrastructure, and technology could boost productivity and tax revenues, allowing the country to grow its way out of the problem. This approach assumes that strategic borrowing today can generate returns tomorrow. Another perspective prioritizes austerity. Supporters call for immediate spending cuts and entitlement reform to slow debt accumulation before markets lose confidence. They warn that waiting for growth is a gamble that could end in crisis. This approach assumes that fiscal discipline must come first, even if it means short-term economic pain. A third perspective focuses on revenue. Proponents suggest raising taxes on corporations and high earners to close the deficit without cutting programs. They argue that the wealthy have benefited disproportionately from recent growth and should contribute more. This approach assumes that redistribution can address imbalances without harming the broader economy. Research indicates that some combination of these approaches will likely be necessary. The question is timing, scale, and political will. The $38 trillion debt is not just a number on a government ledger. It is a choice made repeatedly over decades to prioritize the present over the future. Every dollar borrowed is a dollar that must be repaid with interest, and that interest is paid not by politicians, but by taxpayers. The burden falls on workers, families, and businesses trying to build lives in an economy increasingly shaped by decisions they did not make. The deeper question is what kind of country America chooses to become. Will it remain a nation where each generation inherits greater opportunity than the last? Or will it become one where the promises made to previous generations consume the possibilities available to the next? The answer will not be found in economic models or political speeches. It will be written in the choices made today about spending, taxation, and the very meaning of fiscal responsibility. The clock is ticking, the debt is growing, and the decisions cannot be delayed forever.